Ever wonder what data is used by investors and economists to predict and understand how our economy is doing? Would you like to understand different sources of economic data and what the heck they all mean? Hi, I'm Garrett Ray, financial planner here at the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to discuss what are leading economic indicators and what are lagging economic indicators. This one's going to be all on Garrett here. I'll bring your attention to the like and subscribe buttons down below the screen there. Go ahead and click on those if you want to catch future episodes of The Vault with Doug, Garrett, and myself. And let's go ahead and delve into this one here, Garrett. Leading and lagging economic indicators. Why don't we start off with leading? What are they and why do we care?
Yeah, so we're getting a little bit academic on this episode of The Vault, but we thought everyone might want to be junior economists out there.
Take us to school.
Yeah, what is a leading indicator? So a leading indicator, as the name implies, is a measurable set of data that investors and economists can use to detect shifts in the economy before they start to take over either a region or a country. If it gets really extreme, perhaps, we're talking a global economic change. And effectively, there are different brackets of data that we can look at just to detect shifts. Are we strengthening? Are we worsening? So let's go through some examples, Brice. One that makes the news every so often is called the Purchasing Managers Index, or more commonly known, the PMI. This is essentially a survey done where they're looking at individual managers at big corporations who are producing physical goods. What types of raw materials are they purchasing, and specifically how much raw material? It makes sense, right? If a company is starting to decrease its purchases of raw materials to make their very goods, that could signal that they're having trouble either selling their own goods, or perhaps consumer demand has died down some. And that can be a prediction of, okay, if this is happening at a countrywide level across many, many different companies, now we're starting to see and expect a slowdown in the supply of goods that are available, which means that the economy could start to trend downward. Obviously, reverse that if it's true. If the companies are purchasing more, they're very bullish about their sales forecast, they see high customer demand, they're purchasing more and more and more raw materials. We all remember that, I think it was 2-3 years ago now, where the price of lumber was outrageous just because the housing demand was so high. Well, what are we at now? Well, housing prices are relatively high as we film this in 2024. And so could we predict that this was going to happen? Well, that was certainly a leading indicator in one subfacet of the economy, that being real estate.
Now, petroleum is one of the main things that is needed to make just about anything. Is that one of the items that a manufacturer would purchase that we can use as an indicator?
Petroleum is a little bit different because there is a shelf life to petroleum, and we have strategic reserves at a country level. Also, companies can basically increase their inventories.
Okay.
So if we're getting really, really technical, we could talk about the size of inventories. Are those growing? Are those shrinking? So if inventory is increasing forever and ever, then that's obviously not good, because that means you're not producing anything.
Right.
Or you can't sell your own inventory. So that's a little bit of noise, and we'll talk about noise here in a second.
Okay. All right.
Let's talk about another leading indicator, Consumer Confidence Index. So this is very raw, but the biggest participants in our economy are you, the U.S. consumer. And so essentially this survey goes out and it's collected each and every month. How confident are people in the prices they're currently paying? Are they getting the goods and services regularly that they need? Do they find any shortfalls? I just can't get eggs on the shelf anymore, that sort of thing. The Consumer Confidence Index, it makes the headlines quite a bit, and for good reason, because if the consumer is happy, then typically so goes the economy.
Okay.
If the consumer starts to become unhappy, where prices are intolerable, or perhaps they can't get what they need, then that could be a signal that the economy is either strengthening or weakening, depending on how that Consumer Confidence Index comes out.
Kind of like the tail wagging the dog concept.
Exactly.
Right.
Well, absolutely. Companies have to appeal to a consumer each and every time.
Right.
That's half the battle. The next big one is Jobless Claims. This makes the news almost each and every month. It is calculated by the Department of Labor each and every month. And what we're really looking for is jobless claims over the entire country. Let's say Chicago goes through kind of a gully where, you know, the whatever's happening in the region of Chicago, there's a lot of jobless claims. But you've got Seattle, Washington, and Dallas, Texas, and Miami, Florida are all booming. That may not be cause for concern.
Okay.
But if economists and investors start to see jobless claims going up and up nationwide, that means that our companies are now starting to struggle and they're having to lay off at a national level. So that may be an indicator that, okay, the economy is going to start to weaken. All of our companies, our major companies out there nationwide, are starting to weaken their own forecasts and lay people off. You can see where this is starting to go. Let's talk about the final granddaddy of them all, the yield curve. There's been a lot of talk about this. This is more about people who are purchasing bonds, and specifically the spread that they look at is what is the yield rate calculation difference between the 10-year bond, which is considered a long-term investment, and the short-term or 2-year bond. And in normal functioning economies, with a country that's doing very well and has a promising future, your longer-term debt typically has a higher interest rate or yield that it will produce versus shorter-term bond purchases. However, if people start to weaken their forecast on the long-term prospects of that government or what have you, then you can start to see a situation called an inverted yield curve, where you're actually getting higher interest or higher yield from your shorter-term debt, your 2-year bonds, versus your 10-year bonds. In the past, this has been a pretty strong predictor of recession in the next year to two once that inversion happens. Interestingly enough, as we sit here and record this in March of 2024, we've been inside of an inverted yield curve for about 18 months now. There has been no recession so far. In fact, it's been anything but the opposite. But very interesting to note, and this is certainly a lot of talk with economists. So there's the leading indicators, Brice.
Okay. So that tells us indicators of what we think is going to happen. Now let's talk about lagging indicators or confirmation of what just happened.
Exactly. So Brice, you hit the nail on the head there. We use leading indicators to detect shifts in the economy or possible shifts. These lagging indicators are the confirmation that we need to understand, okay, did what we see before, did we actually confirm that? Because there's a lot of noise in the leading indicators. Remember, I took the example of, let's say Chicago's having a rough time with jobless claims, but you've got all other cities across the nation that are doing just fine. It could just be isolated to Chicago, not an indicator of national trouble just yet.
Okay.
Lagging indicators are the confirmation we need. The biggest one of them all, GDP or gross domestic product. This is a calculation of a country's entire production in a given year.
Okay.
How is it calculated, you might ask? We're going to add up all consumer consumption. What are we purchasing by goods and services? What is the value of that? If you could imagine your daily transactions at the gas pump or the grocery store, add every citizen in the country, that's consumption. That's one part of the calculation. The next one is government spending. Lots of government spending is tied to not only infrastructure projects, but yes, our military, and there's jobs, trust me, supporting our military in the background. Investment is another part. Not so much how much people are investing in their 401ks or their IRAs. What the government is very interested in is how much are companies investing in themselves or their own company. Take, for example, like an Apple, or take, for example, a company like Intel, and they've got plans approved through their corporate board where they're going to go ahead and build a new manufacturing plant. Intel's going to build a new manufacturing plant, and it's going to take 5 years to build this thing. Multi-billion-dollar project. Not only is the company taking the risk to spend all that money just to build the plant, they eventually have to hire all the employees that go in there and, of course, ramp up the production. So if the government sees that companies are spending in investment of themselves, investing in their own company at a high degree with the intent to produce more goods and services, that can only be healthy for the economy.
Sure.
And then the last part of that calculation, net exports. So if you're looking at it from a country level, it is more advantageous for you to send your goods and services off into the globe and be paid for that versus having to be reliant on another country to produce goods and services. So again, to recap GDP, how is it calculated? You add up all consumer consumption, all government spending, all net investment inside of companies as well as net exports to a country.
All right.
Okay, that's a lot.
It is.
Last one. Last lagging indicator or confirmation signal we look for is CPI, or the Consumer Price Index. This is the big calculation on inflation, which
That's
I know.
the one I've heard of.
Yes, a lot of people have heard about that here lately. And so what are we calculating? Essentially, we're calculating the change in price. It's done monthly, but the big ones are annually, right? Where were we last year compared to this year? But it is calculated monthly. And essentially, the Bureau of Labor Statistics looks at a basket of things that people purchase for day-to-day living. And the main ones are food, of course. Got to have food to live. Energy. Most people need electricity to live. And then they have this bucket, this huge bucket, all items less food and energy. So how is the breakdown? Well, food is about 13.5% of that calculation. Energy is just about 7%, it's actually 6.7. And then all items less food and energy are 79.8%. They look at all of these purchases that we're making and the prices that we're paying and what's the trend there. And that's how we calculate the Consumer Price Index, or we know it as inflation. I want to be very clear here. Let's say it's March as we film this. Let's say that we go through the month of March, and the CPI comes out that, CPI was up 4.2% versus February's 4.6.
Okay.
Now, an incorrect assumption would be that, inflation is going down. Well, the rate of inflation is going down.
It's still inflation.
That still means that in March, prices rose by 4.2%.
So instead of them rising like this, they're rising like this.
Exactly.
Okay.
So
they're still rising.
Right. So, but what you feel as a consumer is, hey, prices are still going up. Why are they talking about inflation going down? It's the rate of price hike that's going down, not that real prices are actually going down.
Even I can grasp that concept.
Okay. Well, that's it, Brice. We went through leading indicators and lagging indicators today. Hopefully, everyone out there is now junior economists.
All right. Well, you can take all that information that Garrett gave you to the bank, and you now know everything that you need to know to go out there and make investments or be able to predict where the economy is going. All right. Well, Garrett, thank you for that, taking us to school on that. That was very interesting. That's going to wrap it up for this episode of The Vault. Again, feel free to hit on those like and subscribe buttons down below the screen there if you want to catch future episodes of The Vault with Doug, Garrett, and myself. That's going to wrap it up for this episode. I'm Brice Payne.
And I'm Garrett Ray.
And this has been The Vault.